All right, here it is. This is the Friday before the 18th of Monday, an important day to be talking about the stock market. We're going to be going over a couple of different things. There's one thing I really want to get out of the way first. I meant to talk about this last time. I don't know how I skipped it, but I did. This is the federal funds rate. So, quick explanation for what this is about is this, okay, context. The reason why we even had this incredible, by and large, this incredible bull run for during the COVID pandemic is because this happened. This right down here. This is us again. It says the years down here, right? It's 2020. COVID happened, crashed in the federal funds rate. Okay, and then the bull market took off. The reason why it did is because the federal funds rate is the interest rate applied to the money that is printed by the Federal Reserve, which is then given to loan to the banks, which then the banks loan out to everyone else. In other words, when the federal funds rate goes down, it is easier to get money. It is like, oh, yay, more free money sort of thing. It's easier to get money, that's the point. And then, of course, what do people do with it? Well, they invest it because they want to be able to make money from that money. So they borrow it from the Federal Reserve, and then they try to beat the interest rates on it and all that sort of stuff. Anyway, so this is the reason why it's happening. Now, something that's happened before is when, particularly during this time, this was through the year 2018. You'll see this in the stock market if you look. There were two times it happened, and there was kind of other factors involved, but it was mainly this. This was period after the great financial crisis. We were fucked. They started increasing it, and what happened was resulted with something called a taper tantrum. This was because they're doing it too fast, too much, and the market flipped out and shit. This time around, we're doing it worse than even what happened here. So what I mean by that is if you look at, so first of all, we'll just look at this really quickly. If you look at the increases that were happening at each one of the meetings, really generally speaking, is that you'll see 0.10, let's see here, 0.25, 0.10, 0.15 again, between that range, between 0.10 and 0.25 raises at a time. This caused a taper tantrum, okay? What is happening this time is, first of all, there were expectations for 3 to maybe 4 raises, the federal funds rate through this year. They're now doing 6, and every single time they come together, they're doing straight up, in the very least, 0.25 raises. Right? This defies history. When we had taper tantrums based off of pay too fast, right? It was based off of 0.10, 0.15, 0.25. We're doing just 25s, and there's also possibilities from a number of different board members of the Federal Reserve. They're calling for 0.5 raises. And that might actually happen because China is shutting down again due to COVID, and so that's the whole crux of it with the supply chain issues causing rising inflation rates. So if we see this happen and it's worsening, and it kind of actually is, we're seeing the numbers come out. We just had the numbers come out for March. There's it's gone up to 8% now of inflation year over year. That is not good, and it may very well cause the Federal Reserve to increase it beyond 0.25, which again is historically speaking, at least based off of where we have been in concerns to where the stock market has been, that is not a good thing, that is a bad thing. It is more than what it has been before, and even then, again, 0.10, 0.15, 0.25, we still had freak outs. This period over here, that's just crazy. We had 13% inflation rate. That was nuts. The stock market didn't do so great, but it also wasn't in a massive bubble. So context different for that time period, relates to what happened, but it's not nearly going to have the same impact because we just weren't in this massive bubble back then. We are now, and I go over that in the the other videos, as you guys know. So just want to get that out there. They're raising it more than they have before, and there were freakouts in the market. And again, collective picture, guys. Remember this. This is a thing that has to be had. You need to look back on everything else I've been talking about. Look at the bonds, the dollar, cycle analysis, even COVID, Russia. A couple different things with the bonds and valuations and market breadth. My God, market breadth, please. Over the last couple of videos, just keep all those things in mind and more. But those are the things to look to. 1929 happened because things got too big. We are in the largest stock market bubble that has ever existed. and it's really blatant that we're crashing. So just wanted to get that out of the way. By the way, also, Deutsche Bank is calling for a recession in the U.S. Bank of America is calling for a recession in the U.S., recession shock. Also, even Chase, the CEO of Chase, seeing storm clouds ahead for the U.S. economy. Also, just wanted to put that out there. Let's go ahead and look at let's go ahead and look at the Nasdaq here. So, and I'll go ahead and yeah, that's fine. Okay, so I'll go ahead and I'll guess, you know, yeah, here, let me just go ahead and show you. You know, actually, better, yeah, let me go to the weeks. Okay. So this was the great financial crisis that happened right here, right there, right? And then here's dot-com bubble. So this is the one that we are most closely aligned with in terms of like what the bubble is based around, which is tech, and we're even following it to the day, which you guys know, the 524, 224 thing that's happening, segments here, we went over that sort of stuff, so, but anyways. So the timeline for this crash was to the day, to the actual day, keeping it in line with the thing that we've seen before, right? 524, 224, that thing. Anyways, was exactly 2 years and 7 months. The topping for the IWM was back in November of last year, so we will see, based off of history, knowing that we were following it really, the dot-com crash, and also because like the nature of the bubble, we're looking at the middle June, the middle of 2024 for the bottoming of this crash to happen. That is also just simply one part of it though, because it is completely possible that I get that sort of wrong, that we don't follow exactly like we did just for the dot-com crash. But it's important to keep that sort of in mind, because what happens is understanding the timeline here of what we can expect for how long this crash will last for, alongside the percentage of crash that we can look for, right? For the S&P 500, based off of just a number of different things, 50, 55, 60 maybe even % decline over this sort of time. So the point about this is that they function alongside each other. And the point about it is that if you find yourself at like, oh, hey, it's only been 2 years, right? It's November of 2023, and we're at a 50%, 55% decline or something like that already for the S&P 500. Start considering then taking out smaller chunks over time, over the next like few months or something like that. That sort of thing, out of HIBs, that sort of thing. Because what happened then was that the percentage was met, not the timeline. In reverse, if we find ourselves at the timeline's been 2 years, 7 months, 2.5 years, right, whatever, middle of 2024, and we've only declined 45% maybe in the S&P 500, go ahead and start taking out stuff. Go ahead and start taking that, because based off of history, this is what we can look towards as far as like how long and to the depth of that crash. Just want to put it out there. Context is important to understand that it is not like we're looking for 2.5 years and this percent decline. It's going to be, they're going to be functioning together here. They may not be going, at the same time together, right? You can refer to both of them. You can refer to both of them to be able to, maximize yourself, so to speak, in your gains. So you can rely on either one. Anyways. However, I also want you guys to understand that if the world enters into another cataclysm, like there's another huge COVID breakout, or that requires like economic shutdowns, or the war with Russia starts involving major countries, this may not any longer be 2.5 years. This may be going on for 3.5 years, this stock market crash. That could totally happen. So just keeping that in mind. Okay. So at this point, okay. I'll go ahead and go over this. I'm going to go over a couple different things just really quickly, and then we're going to start talking about calls, a couple different things about that. Really simple stuff, actually. I'm just going to give you like sort of a little bit more about the parts, the nuts and bolts of it, but not stuff that you have to worry about. It's it's stuff that would just, hey, just to be aware, sort of thing. Anyways. So like you guys know from seeing from what we've like been talking about in the last couple of videos, the 18th Monday is a really important day. I talked to you about like why that is. It's because again, if we look at the segments for this 3 segmented parts for the .com crash. Oops, it's all the way here. We see that the very top, just as much as the bottom has 524, just as much as the bottom has been met in this 3 segmented part. We see that 524. We see that here now with 224, 3% chance of that happening. We're following it all the same. The style of the crash, and of course knowing that the crash itself the bubble that we're in right now is very much like the .com crash. Going over all the different, again, like picture guys, all the other things that I talked about, the market breadth, the bonds, the dollar, everything, right? Cycle analysis, like everything. All that stuff. What the IWM looks like, right? And I can show you that really quickly if I can here. Again, massive amount of consolidation. This is a topping pattern. We see this throughout history, and we're crashing out of that. There's a 3% chance of that period before here 524, meeting with, again, this is the very bottom part of these 3 segmented part, 224, 3% chance of that happening. What I mean by the 3 segments, just to go over that really quickly. Someone brought it up before as a question. There's this, as the first part of the crash happening, there's this consolidation period that happens where you see resistance lines up here, support lines down here, that sort of thing. And this is the lowest point. This is the highest point of this, right? This sort of period. That right here, that's 524 again, 224. We see it over there into like what's happening now, and then of course why this is the 3 segmented part, why it's consolidation is. I mean, you can kind of see it's going a little flat, and then all of a sudden it starts crashing. This is the breaking out of that consolidation period, and then it continues on to this crash, and that's why we have this 3 segmented part. This happened across all the different indices. It happened across two of the recent crashes that happened, the .com crash and the Great Financial Crisis. This is something of a pattern that we're seeing. The stock market absolutely has patterns. Anyway, though, so I just want to say really quickly about the 17 thing, the 18 thing. The very top for that, again, was the 17th year. We don't have a 17th. Instead, we have the 18th, but we don't have an 18th here now because they've been implying, the market makers, so to speak, have been implying that there's this day forward sort of thing, this movement here, because they don't ever show the weekends. I've gone over this sort of stuff before, but I'll just do it again really quickly. They don't ever show the weekends. For the first time that I've been using this for a while now, for the first time in the last couple of weeks, they've been moving the days forward by 1 for some weird reason. I wonder why. Again, 3% chance, context, right? They're linking up with the days. They want to do it again. They want to link up with at least a significant day. There's a reason why it's happening, so to speak. Anyways, the 16th is Saturday. They don't show the weekends. In fact, again, like here, let's go 1 little day forward, and you find yourself at the 19th, right? Here's the 19th. 16th, 19th. They don't show weekends, guys. The 16th is a freaking Saturday. Why is that? The 17th, back in the .com crash, we don't have a 17th, it's Sunday. So we have an 18th. They move it 1 day forward. Anyways. So I wanted to talk about, the reason why I'm bringing all this sort of stuff up anyways, is because I wanted to talk about what we can look towards for the 18th, the day of. I was looking back at we call this technical analysis. I was looking back at these sort of movements that we're seeing. Again, we're following this one to the day, this .com crash for the NASDAQ, tech heavy, just like we are now, tech heavy, technology heavy. Anyways, what I think is most likely is we will find ourselves completing or fulfilling the consolidation period right now, this bottom part to the second segment. So what I mean by all of this is if you look at the days here, and I was weighing it between this earlier, I was weighing it between the .com crash movements and the Great Financial Crisis movements as far as like the 18th onwards, right? What we're like looking at. I'm leaning more towards now here because if you look at, let's see if I can explain this really quick. Okay, so you see this red candle, okay? It brings us down into this consolidation area, and then we go up, right? It's consolidation because they're lining up with each other's bodies or movements. There are areas that are covered. They're lining up with each other. It's sort of a flattening going on. It's short-lived though. So there's this big red candle, brings us down into this, and we see this consolidation. There's 3 candles here. Before before this day that brings us out of it, okay? Before it brings us out, we're also in earnings right now. It's important context. We're in earnings right now. We get good earnings. I'll be functioning to this sort of idea that's being talked about here. So 3 candles here, brought in by a red candle, 3 candles there before there's that 4th candle that brings us out of it. What do we see ourselves here now? Again, we're looking at a significant day. Before I was thinking like, oh, I think what we'll do is we'll follow up with what happened here where it was that sort of topping. Not necessarily so. I think it's just a significant day. And that very well could be functioning the 18th here as this day. This is also still a significant day because this is the bottom, the fulfillment of the consolidation for the end of the 2nd segment into now the 3rd. What do we see here? We see a red candle bringing us into this and 3 candles of consolidation. They are mapping up with each other's bodies and movements. The flattening. I'm thinking, again, nothing here is guaranteed, but I'm thinking what's possible is that we see the 18th, where we see a candle very much like this, where it completes that. It stops as well at the you could say the line of resistance here for this consolidation area. And then from there, we are launched upwards into a rally during earnings, into then the top, towards the top of the 3rd segment. None of this is guaranteed, and the point about this is that this, I think, is what may very well happen, but I could get wrong. So if we don't have this fulfillment of the consolidation period for the 18th, because it's a special fucking day, it is indeed, oh shit. Anyways, it's special though. It is special because the 24th here mapping on like that, that's not a coincidence, guys. There's a 3% chance of that happening. We're crashing right now out of the largest stock market bubble that's ever existed. Like, it's a bit too plain. Again, context, please put everything else into it. Cycle analysis, bonds, dollars, everything I've gone over, everything. Market breadth, please. But it's not too much of a stretch of the mind because it's happened already and it just happened. But it's not guaranteed, right? So what happens if the 18th comes and we see this like breakaway from the consolidation, we see this breakaway where the body of the candle. So you see these lines, that's called a wick. And then you see this thicker part, that's the body of the candle. The wick is just like where it goes during the day, and then the body talks about where it started and where it ended. So for red candles, this goes down, right? It starts up at this thicker part and ends at the bottom part here, right? The end of the thick part. And then green candles are the opposite because they start up here and they go up, right? The thick part here, this is a good example, right? Started right here, it ended right there. But it went during the day, it went to this length, so it went down and went up. Anyways, so we find ourselves where there's this like detached ass candle, like it doesn't even, maybe the wick is involved here. This is an idea because I also saw this from the great financial crisis. It's something that we have to talk about afterwards. It's just an idea though. If it breaks away though, that's also a possibility. If it breaks up and above, you can close off some gaps. Again, we'll be talking about this later on the 18th. After the 18th, we'll be talking about this in the group chat. But have in mind, if it fulfills this, thing is actually likely, because again, we're following this shit into the top, to the top of the 3rd segment that we saw for the .com crash for the NASDAQ, into that. Anyways. Okay. All right. All right. Let's go ahead and do this. Okay, so there's that. That's all I wanted to do for this. Now let's go to the board. We gotta talk about some stuff doing with calls and other things of the nature to do with things that have stocks involved. Just trying to fill in airtime there. All right. Okay, here we go. All right, cool stuff. Okay. All right. Okay. Well, let me get that out of the way. Hopefully it wasn't too boring. But it's important stuff to be aware of. And again, we'll see this. On the 18th, we'll see what happens. There's some big names coming out. There's Goldman Sachs. I think there's I know like a couple of big banks that are coming out too. So we'll see about all that. But anyways, it's a big day. It's an important day. It's a significant day historically. So we'll see what happens. All right. Okay. So this part I'll just get right into it. Okay, so we were talking about before calls and the shares that you have of, for example, because this is what we're looking at, again, not financial advice, but ideas, right? HIBs, okay? How this functions with like getting calls, we were talking about this before, that options, whether it's call or put, but we're just gonna look at calls, right? Right, equals or references 100 shares, okay? You have the right to buy them at this like strike price, blah, blah, blah. Anyways, check out the last video that I explain it. There's a couple different ideas here in terms of how much we allocate our funds to this sort of stuff. So there's one idea, which is that, and it's gonna be something like approximately like for you, I would believe. But if you get 100 shares, okay, and then one call, here's like step number one, step number two, repeat. Right? You get 100 shares, one call. 100 shares, one call. 100 shares, one call. It's you buying it. You buy 100 shares, you buy one call, right? It's just over that over again. That should equal about 10% of your funds going towards, this is just based off like what I've seen before a little bit around this area. Kind of varies a little bit, doesn't matter, don't worry about it too much. Anyways, it has to do with the price of the actual call. It's fluctuated since then because the stock market's done its thing. Anyway, this was very recent though. Should be about 10% of your funds going towards calls, options. As an idea, up to 25. Again, I talk about why these sorts of precautions and concerns. Well, wait a second, why couldn't I get more calls? That sort of thing. It has to do with like naked calls, the volatility involved in the stock market, blah, blah, blah. But if you want to put 10% to 25% of your funds towards calls, cool stuff. It's just an idea. I might be doing 15, 20%. I don't know. I still have to figure that one out really, but make a decision sort of thing. But we'll see. Just ideas. Just want to talk about it. Okay, so now I'm going to talk about 4 different things having to do with options. These 4 things are not so important to be like really understanding, just to at least be aware of the fact that they exist. That's kind of really it. That's the point I wanted to do with this one. So first we've got delta. These are the Greeks for options, delta. Delta has to do with, again, and the reason why in particular these things don't matter is because we have option strat. Option strat, that app that I told you guys about. I'll be sharing that more into the group chat so you guys can see it, what it looks like, getting it, blah, blah, blah. Anyways, that thing takes care of this, really, basically. Takes care of the delta, the vega, the theta, and the blah, blah, blah. All right, so don't worry about it, but be aware that's a thing. Okay, so delta. Delta has to do with how much the option, the value of the option, goes up per the 1% move of the stock. So if you have a call and the underlying security, which is just like bids, right? It goes up by 1%. Okay, cool. Delta tells us how much the price, the value of the option is going to go up. Understanding it's a call, right? Anyways, how much that goes up in regards to this going up by 1%. Okay. Anyways, there's that. And then there's gamma. Gamma functions to support delta. Okay. It's just something that functions alongside it. Your thing goes up. Cool. The value of your option. Anyways, and then there's theta. Theta, all right, that's an E, and then that's an A. Theta is just talking about time decay. As time goes on, the value of your option will also like decrease. Don't worry about it. Again, option strat takes care of all that sort of stuff. You don't need to calculate any of this jazz. It does it for you. And then there's vega. Vega is talking about volatility. Volatility is a good thing here. If it's more volatile, so to speak, which is that means like the stock market's just going like this. There's wider moves, so to speak, over time. That's just a good thing. It's actually good. That's how that one works. That's how Vega works. Again, who gives a shit? None of it matters because you have option strat. It takes care of that all of it for you based off of like a formula that is used in understanding what like the outlook for a an option is, based off of like average volatility and stuff, and you're not going to be expecting anything too crazy anyway, so like don't really worry about it. Worst case scenario, it's good because like the market's crashing, so volatile. Anyways, so like don't really worry about it. And then just 3 more things here, really quickly. I want to talk about like so for example, don't take this too literally, but on the 18th, let's say the stock market fills those gaps. Again, we'll talk about this more later on the 18th and thereafter. It fills those gaps. It's like, all right, there it is. There's this day that's significant. It should be fulfilling the sort of patterns that we're going to be looking at, blah, blah, blah. Anyways, I want to buy. I want to buy on the 18th. And then, because this is what we do in swing trading, as far as like long-term investing, it depends on who you ask, but like long-term investing's generally, it's probably, generally speaking, something you just like do as a one-off sort of thing, like I'm just going to put this money to it, or on a regular basis because I got my paycheck and I'm just going to keep putting it into it and not really think about it too hard. For swing trading, there's more, I don't want to say timing, it's just more of like here's this 5-day period based off of technical analysis, this is going to be an opportune time for me to put my money in. As ideas, through this week, the 18th to, I don't know, the 22nd, that's Friday. Here are these 5 days, right? The splitting of this as an idea, again, not actually financial advice, none of it is, but just as ideas, I have $100, okay? 30% of that funding is going to go towards the 18th. Why? Because it's the most opportune time. So here's $30. And then here's like the next day, the 19th, and I put $20. I used this example earlier. Anyways, here's $20. I've used 50%. I got 3 days though. There's 2 days of your 3 days. I used 50% already. You can see that there's a leaning towards something else. There's a leaning towards a particular day, a couple of days, whatever. Through this, I evenly split it, right? I have 50%, 50 divided by 3, or it's the opposite, but you know what I mean. And I got $100, so it's like, okay, cool. So whatever 50 divided by 3 is, and it's like, here is that amount of dollars going towards the 20th, the 21st, and the 22nd. I want to do evenly, so to speak. Just ideas about how to divide up your funds when you start investing. Again, we'll be talking about what's actually going to happen depending on like what the hell the 18th does, because it's that special of a fucking day. Anyways, there's that. Just covered in chalk. Anyway though, so there's that. And just, I think just like maybe, just 2 more, okay. So for those who, because they do say like, hey, like you should have like a basket in your eggs, or you should have multiple eggs. I said eggs plural. Anyways, eggs plural in your basket. We're kind of just looking at HIBs. Reason why is because of like what that shit did, and we know like what it is too. It's beta. Anyways, don't worry about it. It during the COVID crash went up 400%. There are other ones that went up 360, but then it's, anyways, doesn't matter to me. Don't worry about it. HIBs went up 400%, 4 times. There were other ones that went up based off of the same indice, the NASDAQ, that crashed about the same, 35%. That went up only 200%. It only went up twice, right? But if you want diversity, just as an idea, if you want diversity involved in all of this, instead of just simply HIBs, I'm doing balls to the wall, I don't care. Here's a couple of them that are the next best ones. They're really not as great as HIBs, but they're all right. They're all right. You're gonna do fine. But if you want diversity for the sake of diversity, then here's some ideas. SRTY. Okay, these are the tickers. I'm on Webull. I want to look up the freaking particular stock. I'm gonna be like Tilray or something like that. The ticker for Tilray is TLRY. You put that in, and it's like bam, here's Tilray. It's a marijuana company, by the way. And then it finds you. It's like, all right, cool. SRTY. This is based off of the Russell 2000. You have JDST. It's based off of gold. And then you have TEX. This is based off of technology, unsurprisingly, and mainly the NASDAQ. So there's those ideas. Just ideas. Last part here. Last part. There is. I'll go ahead and get rid of this too. There is a floating of an idea that the Federal Housing Administration is considering. It is the 40-year loan term. 40-year loan term for their FHA loans. We've talked about in this club before about like investment potential, man. Investment potential is all about that sort of stuff. And a lot of it's centered about investment potential. I'm just thinking about a word, apropos. It's a new word recently. Apropos. In concerns too. When we talk about investment potential, a lot of it has had to do with lowering like your monthly payments, even if you have to take on like for a loan a higher interest rate. If you can spread out the loan term instead of like over 5 years, it's 10 years. If you can spread that loan out and you have lower monthly payments, as long as you can consistently beat the interest rate applied to that loan, you are making money. The reason why is because you have more time now. You have more time now to use that money, the loan, than if you were to have a lower, a shorter loan term, right? Again, like 5 versus 10 years. If I go with the 10-year loan, I'm paying it back slower. I have more time now to be able to use that. As long as I can beat that interest rate, I am making money. As a fact, I'm making money. 30-year has hitherto, it's all the fancy words, has thus far been the longest loan term that you can get with an FHA loan. There are have been 40-year loan terms and shit like that. FHA is just kind of the better one, anyways. Just because it's the lowest amount of down payment. Anyways, they're now considering 40. If they approve that and they allow you to get a 40-year loan term rate into the years to come, do that. That's kind of it. Get a 40-year loan term. What this can do is it can save you every single month a couple $100. I looked at a mortgage calculator for what we've been talking about for properties and shit. It can save you a couple $100. So it would be a brilliant thing to do. Way serious advantage I wrote down. Yeah, that's kind of really it. One quick thing I suppose is just to say that referral bonus thing ends at 4:30. I doubt anyone's gonna see this, but give it a shot. I do this stuff for free. Help a brother out. You get 5 free stocks yourself. You can probably look towards, just based off of my own experience, it's about $50. At least 27 though. They do guarantee that. At least 27. All right. Anyways. All right. Goodbye. Thank you. See you guys later on. All right.